get started in just a moment. Before we begin, let's just do a little bit of housekeeping. Whether you use the Q&A chat or the chat box, can you just type in to let me know that you can hear me and see our shared screen? All right, I just want to make sure if anyone can just type it in, if you can hear me okay, and you can see our shared screen okay. All right. So you can use that same Q&A box for your questions. We'll ask questions near the end. So just in case you forget them, go ahead and type those questions in the Q&A box, and we'll throughout the webinar, and we will address them near the end of the presentation. So welcome everyone, and thank you for joining Upside Avenue Educational Webinar Series. This series is developed with your input. We surveyed our investors and followers to find out what financial and investment topics everyone is interested in learning about. And then we look for subject matter experts all over the country who can speak on these topics in hopes of providing you with the knowledge and confidence to discover your upside. So subscribe at upsideavenue.com to know when our next webinar is, or follow us on our social media channels. This presentation is for general information purposes only, and Upside Avenue recommends that you do your own thorough research and due diligence before acting on anything suggested today. Today, we're going to demystify individual retirement accounts, or IRAs, with our fantastic speaker, Adam Sypniewski, a senior member of the business development team at Midland IRA. Adam has over 14 years of experience with alternative investments. Adam specializes in private placements, real estate, and other non-traded assets. His primary role is new business development for Midland's self-directed IRA services. He works with various capital raisers, advisors, investors, and other financial service providers to deliver custody solutions. Recently, Adam led the development of an expanded service offering for Midland, Private Fund Custody. And Private Fund Custody is a solution that helps private fund advisors with compliance and transparency needs. Adam was born and raised in Chicagoland and currently resides in Naperville, Illinois, with his wife and 2 daughters. So without further ado, please help me welcome our friend, Adam Sypniewski. Adam, welcome. Thank you so much for joining us today.
Yeah, absolutely. Happy to be here, Jessica. Thanks for having me. Thanks to you and to the folks at Upside. It's great to be here.
Absolutely. I'll turn the time over to you.
Great. Well, I will go ahead and pull up the presentation that I have prepared for today, and we'll take the audience through the comparison and some items of consideration of those traditional IRAs and those self-directed IRAs. So without further ado, as you mentioned, let's get into it. Okay. So as you see, we are going to talk today about what I put in quotation marks, traditional IRAs versus self-directed IRAs. Now, I will get into why we put that traditional in quotation marks, but let's lay some groundwork first. There I am. Again, my name, as Jessica mentioned, Adam Sypniewski. I'm with Midland Trust Company. You'll find my direct contact there for any questions the audience has. I welcome you to reach out anytime, post webinar here or at any time in the future. Please keep my name as a resource, my information. I'm always going to be here as direct contact should you have any questions. A little bit about who I'm with and who I represent today. Midland Trust, or Midland IRA as we have been known. We provide self-directed IRAs and other alternative custody solutions. You can see some important facts about us there on the slide. I reside in our Chicago office. I work out of our Chicago office, but our main headquarters is down in Fort Myers, Florida, along with our trust company out of South Dakota. couple of important bullets. Right now, we're at about $3 billion in assets under custody, approximately 20,000 account holders, and we are a passive custodian. That's all that fine print means right there. Is, we don't make a commission, we don't sell investments. We are a passive custodian. We're here to allow you to accomplish the investment goals you have made for your retirement account. We'll get into what that means here in just a second. Again, the slide is to again maybe plow that ground of disclosures and disclaimers that I'm not representing. I'm not an advisor here. Everything that I'm telling you folks today is for educational purposes only and for your own use as you consider your own retirement account ambitions and goals. So, getting into the meat of the presentation, let's talk first about what a traditional IRA is. And again, I kind of teased there at the front of the presentation. I put this in quotations for a reason. Well, because a lot of us out there that have been working for some time, or we pay taxes, we earn an income, and we plan for retirement. We might have heard, we may have heard of the term traditional IRA previously. That's because it is actually a tax status. A traditional IRA is a tax status. If you look at that second bullet point, there's actually 4 tax status of IRAs, or at least types, we could call them. There's a traditional IRA, the Roth IRA, the SEP, and the simple. We're going to pretty much focus on the traditional and Roth today. And again, the reason I put traditional in quotations in our presentation here is because a traditional IRA is a formal recognition of a pre-tax account. Those are dollars that we put into a retirement account, before any tax has been taken off the top. It's possible that in some cases, those contributions to those traditional accounts can be tax deductible. But what we mean for the purposes of this presentation is that, these traditional or typical IRAs are IRAs that are held at a brokerage or a bank. A lot of us have, perhaps an account at Schwab or Vanguard or Fidelity to hold, as the slide says, we hold these publicly traded securities and cash. So, while we know we make those contributions every year, we pretty much stick to playing the S&P or maybe a mutual fund or an ETF or something that we know and that has, pretty high liquidity that we feel, will earn us a return over time in our retirement account so that we can plan accordingly. As it says, this is the retirement planning tool for U.S. taxpayers. The traditional IRA is a pre-tax account. The Roth IRA is a post-tax account. So when we talk about a Roth, basically all that means, folks, is that we've already paid taxes after tax money that we're contributing to a Roth account, so that any growth within that account, in most cases, is occurring tax-free. Now, there's caveats and certain rules that we can get to, but for the basis of this discussion, it's important to realize that traditional IRA is a type, Roth IRA is a type, and that's really just a pre or post-tax note of the cash going into the account. So again, we covered, these are traditional securities like stocks, mutual funds, ETFs, and the things that, again, have a high liquidity. And these investment options are, in most cases, put in front of you as the account owner by the wirehouse or the brokerage that you work with. So, this is a list that's been curated by that provider, by, Fidelity, by Vanguard. Perhaps they have target date funds that, in some cases, in most cases, they might be earning a commission on. So they are incentivized to put these specific products in front of you. What are some common themes or things that we commonly see with these typical IRAs, these traditional IRAs? I kind of touched a little bit on it on the previous slide, but I think what we'll come to find out is, and the audience will come to find out, is most times these IRAs are funded via rollover from an employer plan. We leave a job, we're getting a new one. We have that old 401k at our employer, and we think to maybe roll it into the new plan with our new employer, or we can take it independent and keep it out of a plan by rolling it into an IRA. And the thing about this is how we get that $100,000 million IRA, whatever it might be, because as we'll get to, there are contribution limits to an IRA. You can only contribute $6,000 a year. So how do you get eligible for these private placements and the like? Well, folks tend to roll over an employer plan because, one, we can defer up to about $19,000 in annual income into this account, and our employer in a lot of cases matches some of that contribution. So instead of $6,000 a year, you're usually looking at, the high end, $20,000 or more going into these types of accounts. So you can, accrue a significant balance in an IRA by rolling out of a plan that you've, contributed for some time. The other common themes of an IRA are really for tax strategy purposes. I alluded to in the earlier slide, contributions to traditional IRAs can be written off in a lot of cases, so people can lower their taxable base that way. The other way we can mitigate some of those tax hits is, dependent upon the investment that we are using, or looking at, we can defer capital gains or avoid capital gains altogether if we're making an investment out of our IRA. Because that IRA is tax sheltered, there's no cap gains on any of the investment activity occurring underneath that IRA. So, while it's under that umbrella, no tax hit. It's when we start to take distributions out on the back end. That's where it's that's where it's treated like regular income and taxed as regular income. Another couple common themes that we see here, that people treat their IRAs as sort of a set it and forget it vehicle. This is a passive investment strategy. A lot of times we don't see day traders with their IRAs. This is something that they're planning on, future value in say 20, 30 or more years. So this is really, investors tend to buy a stock or find another type of investment opportunity, place their investment with that offering and just kind of let it ride, for years and accrue in value. We're taught these things in consumer education about the rule of 73 and compounding. And that's really how most people see their IRA, is that, this is just something I contribute to. And by the time I'm 65, there'll be $1 million waiting for me. Well, there's a little bit more involved than that, but I think that's the general attitude that most folks take towards their retirement account. It's really something that's untouchable to them. They will, maintenance it, contribute to it in as the kind of years go by in their 30s and 40s while they're working. But again, it's a separate entity to them. They don't want to touch it. They know that it's their nest egg for retirement. So switching gears here, let's talk about the other side, the other topic for today, which is self-directed IRAs. Now, the important thing to clarify up front is self-directed or self-direction is not a tax status. It's not a formal IRA account type. You can self-direct your traditional, you can self-direct your Roth IRA. Any of those IRA types we already went over, you can self-direct. All it is really, truthfully, is a marketing term. It means that you, the investor, you, the taxpayer, you, that IRA account owner, are empowered to go out into the market, including the private market, and find an investment opportunity that you want to put your retirement account towards. Really, the world is your oyster when it comes to self-direction, meaning there's only two hard and fast investment types that the IRS outright prohibits. That's collectibles, things like, rugs, cars, vintage bottles of wine, things like that, or life insurance policies. Those are the two things that you cannot hold directly. Anything else, there are no rules. That sounds pretty cavalier, but there really isn't much legislation around this or much verbiage around it put out by the IRS. If there's a paper trail and we can, we meaning, your custodian of record can, recognize the transaction as occurring under your IRA, chances are they can do it. We've had some pretty odd things come our way over the years, including, livestock, Super Bowl tickets, and most recently, as I'm sure most of the audience is aware of, things like cryptocurrency, and other new asset classes that are developing. So there's nothing that's I can't say that we've heard it all before, because there's new things that come along all the time. But I think the important takeaway here is that if you can find a paper trail, let's talk about it. There might be a way that we can fit something a little bit unusual inside a self-directed IRA. And as you've kind of deduced by now, I'm sure these are all private investment opportunities. These are not stocks and funds traded on an exchange. These are private opportunities, things like real estate, things like REITs and other products, like our friends at Upside offers to, their investors, private lending, private placements like hedge funds or private equity, venture capital. These are things that are held in a self-directed account. Again, non-traded, not marketable securities. I think the biggest thing to take away for the audience is it's still an IRA. It's still subject to the same contribution limits. income eligibility brackets, early withdrawal penalties, everything that the IRS has as its disposal to govern these accounts. It still applies to self-directed IRAs. You don't you're not exempt from any of those other rules. I went into this pretty deep on the earlier slide, but again, there are several investment options that you can pursue using a self-directed account. Again, as long as there's like a paper trail, like a prospectus, like a PPM, like a subscription document, a deed to a property, things like that. That's the way you need to approach these opportunities. If there's a way that we can, or your custodian can, paper the transaction to your IRA, it's likely that they'll be able to pull it off. So I'm not going to go through all these item by item, but I think the audience can take a good look at it and understand that, again, there's not much limiting you here in terms of a self-directed IRA as to what types of deals you can access and earn a return from. So here's some important rules when you think about self-direction and some of the maybe the fine print, some of the operational details that we need to be mindful of, especially when it comes to things like real estate, hard real estate, like, if you're landlording or fixing and flipping, these rules might be particularly important to you. All assets are titled in the name of the IRA. So that includes the name of your given custodian. So for, clients at Midland Trust, we're going to title every account or the registration of every investment as Midland Trust Company as custodian for the benefit of Adam Sypniewski's IRA. And that's a key piece to keep in mind, because folks will think that, hey, just because I filled out a subscription doc or prospectus for to invest in a REIT, if I just put it in the name of my IRA, or I put IRA after my name, I'm all set. Well, that's not really the case. You do have to work with a custodian with a self-directed account. The IRS does need that qualified third party to report on your account's behalf. And these are the types of things that we'll take care of for you, but you do need to be aware of, because sometimes, people do like to understand these types of things so that they can mitigate some questions when it comes to their participation in a given private investment. The other kind of things that we see here, IRS wants you to treat your account as an investment vehicle. All assets, think of, again, like real estate, there's no personal use allowed, for assets or investment opportunities sitting in your retirement account. So, if you are, looking to help fund a new golf course that's going in your community, and they're offering you, for every $50,000 that you invest with them, they will give you a country club membership. You can't accept that membership. You're personally benefiting. So these are very hard and fast rules, and I would advise the audience here today to be, maybe not intimately familiar, but know that they exist, and do lean on your custodian, do lean on your CPA and other tax advisors for these types of things, because there are some significant penalties that can come up if you don't follow the rules. I think the main rule that we want to cover today, to keep it as a baseline understanding when it comes to self-direction, as that last bullet says, is no prohibited parties. Well, who are those prohibited parties? We mentioned earlier that there's really only two asset types that we can't invest in with our IRA. And I'd like to say, when this comes up, is that, it's not so much what you can invest in, it's who you can invest with. So these prohibited parties define who you can invest with, and it's really anybody that's outside of our family. So the IRS tells us that our lineal family members up and down our family tree, that's ascendants and descendants, are prohibited parties to our IRA account, including ourselves and our spouse. So that's what this slide really indicates, is just that our grandparents, our parents, our children, and our grandchildren are not individuals that our IRAs can directly transact with. Again, you'll have a custodian, you'll have a CPA that'll guide you through the finer points of this, but just best to keep in mind that, when I'm going to self-direct my account, as I'm considering opportunities, I can't say, own a house in my IRA and rent it out to my daughter to live in and rent from me. Just some, again, philosophical things we want to keep in mind when considering self-direction for certain asset types. I kept this slide brief because I think it really is important to realize that there's not much distinction here. We talk about similarities and differences between traditional IRAs or typical IRAs and self-directed IRAs. Similarities are almost all the tax treatment, the contribution limits, the income eligibility requirements we talked about. We already covered that. We know that does not change if we go self-directed. Also, something that becomes more apparent as we self-direct our IRAs accounts is cash flows and reporting. Everything still goes through the IRA account. If we open up an IRA at Fidelity and we own Amazon stock and they're paying a dividend, we know that dividend is going to come right back into our IRA at Fidelity. It's the same thing as if you had an IRA at Midland and you owned a piece of property, or you owned an offering from Upside and they were kicking off a dividend, or you were receiving a rental income from a property. That cash flows right back into the account at Midland, into your self-directed IRA. There's no difference there. And again, reporting it's a tax sheltered vehicle here. So, your custodian, whether it's Charles Schwab for your stocks and bonds or Midland Trust for your alternative investments, we're going to report to the IRS on your behalf to make sure that you're not, receiving any sort of tax liability for what's occurring underneath the umbrella of that IRA. Really, the only differences here are the types of investments that you're allowed to access with that account, or that, your custodian allows you to access, where the core competencies lie. Again, with Midland, it's these private investment opportunities. With the larger custodians, it's those public investment opportunities, the stocks and ETFs. And I also put investor responsibility here because, as we kind of covered on the earlier slide, there are some differences or key ways of executing your investment paperwork that you need to be aware of. A lot of times your custodian will hold your hand through this process, but just know that you have to do things by the book here. There's a lot of ways you can make mistakes and landmines that exist to where, you can, receive some pretty steep penalties from the IRS if you don't do things right. And there are, horror stories about folks, having to, have their whole, IRA distributed as a taxable event and levied an early withdrawal penalty on top of it. So you want to make sure that you're doing things the right way. And that there is a little bit more awareness, a little bit more responsibility that comes with self-directing. So which choice is right for you? I think the beauty of this is that you don't have to choose. You can have both. Many of our clients have the bulk of their IRA, their retirement assets, at a large custodian. And what they'll do is they'll just transfer off a piece of that retirement account, $50,000, $100,000 cash, to bring over to an account like a Midland self-directed account to invest in a specific deal. They come to us with that deal in mind. So it's pretty common for them to hold one deal with us and, at a $25,000, $50,000 clip, and the remainder of their assets, that, $200,000 remaining balance at Schwab to trade the market. It's a diversification technique. If you want to diversify your portfolio away from the market, you'd self-direct a piece of it into some alternative that that you're familiar with, that you're comfortable with, that you believe will earn you a return in your retirement account. The other thing to kind of keep in mind, and this is, might help your decision making, and if you feel comfortable self-directing, is that the IRS looks at all of your IRAs in aggregate. So while I, Adam Sypniewski, have one IRA at Schwab and one IRA at Midland, I don't have contribution limits for both those accounts. I don't have $6,000 of contribution dollars I can make to both those accounts. I have, as Adam Sypniewski, the taxpayer, $6,000 a year that I can contribute to any of my IRAs in total. That's it, $6,000, no more. If I was over the age of 50, I'd have $7,000. But again, that's just those standard limits that the IRS dictates. And as that last bullet says, there are no restrictions around moving money between those IRAs. As I just described, a lot of folks have a multi-custodian relationship for their IRA investments. So you can move that cash between your Vanguard account into your Schwab account and to your Midland account without penalty. There's no tax liability moving between IRAs, and they don't limit the amount of trustee to trustee transfers that you can execute a year, much like they can with an indirect rollover, if you're familiar with that rule. So again, it's another bucket that you can have if you want to put some of your retirement assets towards an alternative like real estate, like a REIT, like an Upside, like a hedge fund, like a private equity, like a startup company. So there are, it doesn't limit you as much as it, really empowers you to find and expose your retirement money to a different type of an asset class. So how would you get started? Well, you'd, once you've chosen a custodian like a Midland Trust or another self-directed custodian and or administrator, you'd open up an account with that custodian. We do everything mostly paperless and online. So you'd log on to our website and click open an account, and it'd take you through our online application. And then the key second point there is that you fund your contribution one of three ways. As I mentioned on an earlier slide, number 3, rollover is probably the most common because we get those significant balances that way. But as we covered on just the previous slide, you can transfer from another IRA elsewhere. Again, neither of those carry any sort of tax liability. The third and probably least common way that we fund our IRAs, and the number 1 option listed here, is contribution. That's that annual $6,000 limit I was talking about, or $7,000 if you're over the age of 50, that we can use to put as cash into our retirement account. With a traditional IRAs, there's chances that you can deduct that from your income tax return for the year. But again, that's subject to some income brackets put forth by the IRS. So once your account is open and funded, you choose your investment. Most folks know that before they open the account, but once the IRA is open and funded, again, the marketplace is yours to find your private investment opportunity to direct your own account, and execute on, by your custodian on your behalf. So it's a pretty simple process to get started. I know this is a lot to digest, and it's probably a new thing for most folks, but most custodians will do what they can to make it as easy as possible for you and be that resource to get done what your ambition is with your own retirement account. Again, I'm flashing my contact information up here. If you do have any questions, I do encourage you to reach out directly. I'm more than happy to be a resource for any investors, capital raisers, whatever the case might be. And I think that does it for my end of the presentation, Jessica, or at least what I had prepared for today.
Perfect. We'll open it up for questions. Please type them in the Q&A box. And while you're doing that, I'll ask you a couple questions.
Sounds great.
What kind of information does an investor need to open an account? And is there a minimum amount needed to open that account?
Yeah, great question. So it's much like opening up a bank account, Jessica. So, really you need your personal details, your name, date of birth, social, things like that, all things that we've memorized. But really, it's just the kind of, outside of our memory items that we need to bring when opening an account is funding information. I went over the 3 ways we can fund an IRA. Most custodians are going to want you to have that at the ready because, they'll need to initiate a transfer from your existing IRA at Fidelity. So you want to have those Fidelity account details ready, or your 401k plan details close at hand. But that's really all I would say. Perhaps your beneficiary. Not all of us have our wives or spouses social memorized, so they might ask you to assign a beneficiary when you sign up. So I would mention those 2 things as probably the only things that we don't have memorized to open an account, Jessica. And when it comes to minimums, there are typically no investment minimums or account value minimums, though some custodians have like a cash balance minimum, idle cash to remain in the IRA that can't be put towards the investment, and those vary across the industry.
Okay, perfect. How do we know if we qualify for a Roth IRA?
Yeah, great question, Jessica. So as I went over in the presentation, a Roth IRA is a post-tax retirement account. The IRS dictates that not everybody can contribute to a Roth IRA. And that's, again, this is after-tax money just being put into a Roth. You have to, there's income limits involved here. So I think it's for 2021, it's for joint filers, so folks that are married and filing together. If your joint income is $198,000 or greater, the phase out period begins is what it's called, meaning at 197,000 you can contribute $6,000 a year, but once you start earning more you can contribute less until you earn an annual income of 208,000. You are no longer eligible. Again, that's for joint filers. For single filers, I believe the income band it starts at 125,000 annually, meaning if you have 125K in income for the year, up to that point, you can contribute the full $6,000. Once you pass that $125,000 threshold, you'll start to be eligible to contribute less. And then when you get $140,000 of income for our single filers, you are no longer eligible to contribute to a Roth. Now, you can always convert your traditional IRA to a Roth, but that's a taxable event. You know, there's other ways we can kind of get to a Roth account, you know, with backdoor Roth IRAs and things like that. That's a little technical, but know that to contribute new money to a Roth, there are income eligibility requirements that you have to be aware of.
Perfect. Let's see here. How long does it take to start investing from a self-directed account?
Sure, yeah, because these things take time, Jessica. You know, we use online application. We try to do things, you know, with e-signature where possible, but there's still some friction in this process. So to open the account and initiate funding, you know, you do that online in mostly a matter of minutes for most custodians out there. It's waiting for the cash to come into that account that typically takes the longest. Whether you're transferring from an IRA elsewhere, or particularly when you're rolling out of a plan like a 401k or a 403b, those things take time. Some custodians will only send a check from a 401k, and so we're subject to the U.S. mail getting us that check. What I typically tell people is that end to end, that means from when the time you open the IRA to where you fund your investment, that typically takes 2 weeks, give or take. So I'd say if you're looking at a closing date or a particular fund launch or something like that, you'd want to start the process no later than 2 weeks before closing. So give yourself at least 2 weeks, but the more time, the better we have to make sure that we get into your investment on time.
Great. Good to know that we have that window of time frame to keep in mind of.
Yep.
Do you have to have an investment in mind, or do companies like yours have a list of investments I can choose from?
That's a great question, Jessica. So if you remember at the top of the presentation, I called Midland Trust a passive custodian. And what that means is that we're not an active manager. We're not a fiduciary. We're not here to provide investment advice, tax advice, legal advice. We actually are restricted from doing that because we are a passive trust company. We're not here. We don't have any ability, or we're actually regulated against putting investment products and opportunities in front of our clients. So you won't come to Midland and see, you know, a mall of alternative investments. That's just restricted in our industry, and any custodian that tells you otherwise might be skirting from.
Oh no, do we have technical problems here? Adam, can you hear us?
These are self-directed accounts. Folks typically access the public markets, and you know, you can't just, you know, temporarily put your cash in the market. So I think that's what's important to keep in mind, is that there is no, you know, shopping list of investments when you show up at a self-directed custodian.
Adam, you froze there for a second. Would you be able to repeat your answer for that? Do you have to have an investment in mind, or do you have a list of investments to choose from?
We do not have a list of investments to choose from. As a passive custodian, we're restricted from introducing an investment product. It could appear as a recommendation or advice, which, you know, we're not a fiduciary, and so we have to stay away from presenting opportunities to our clients. So most folks will have a deal in mind when they come to us, though they don't need to.
Like a deal like Upside Avenue.
Exactly. So yes, if, you know, someone approached Upside Avenue and they wanted to use an IRA, that's when, you know, Midland would be able to facilitate that transaction.
Great. Well, if there's no other questions, Adam, did you have any last words that you wanted to say before we bid everyone a good afternoon?
Well, thank you again, Jessica, to you and your partners over at Upside Avenue. It's been great to be a part of your educational series. I commend you for what you're doing and you know, raising awareness in the marketplace. So thank you. And again, anybody in the audience that are listening to this now or in the future should feel welcome to contact me anytime.
Perfect. And thank you for joining us today. If you'd like to contact Adam, let's see, there's his information on the screen there. You can also let us know if this content was helpful for you by taking the short survey at the end of today's session. And also, let us know what other financial and investment topics you'd like us to cover. Let us know what's keeping you up at night. We will find subject matter experts like Adam who can speak on these topics, because at Upside Avenue, we're committed to helping you live your upside. So don't forget to subscribe to our newsletter and follow us on social media. Also, check out our library of past webinars at upsideavenue.com/learn. Discover your upside with Upside Avenue. Through our non-traded REIT, you can enjoy the benefits of multifamily real estate investing for as little as $2,000. You can visit our website, upsideavenue.com, or contact us directly for more information. Thank you everyone for joining us, and stay safe. We'll see you next time. Bye now.